Well, Secretary General, distinguished guests, ladies and gentlemen, good evening. And thank you for giving me the last word. My wife so rarely does so. As you've heard, I had the honor of working at the Bank of England. It was an exciting time. Banks were undercapitalized. Greece threatened the Eurozone. The Eurozone threatened the banking system. The politicians were threatened by the bankers, lest the politicians threaten the bankers too much. And as I was leaving, the political leaders were leaning heavily on the regulators to make sure that the regulators did not lean too heavily on the banks. Too big to fail, bail, and jail summed up the challenge. Capital and accountability have framed the regulatory response. There has been much activity. But although the motion has been great, the movement has not. Leverage remains high and accountability low. And sadly, the courage to address either seems lacking. So capital, accountability, and courage. All other issues pale in comparison. So let me say a word about each, and I'll start with capital. We continue to work our way through the largest credit bubble in history. Now, bubbles are not new. They're always the same, and they're always a little bit different. They all involve heavy doses of greed and stupidity and leverage. Now, what differentiates the recent episode from all others was the degree and the magnitude of leverage. And we're not going to abolish greed, and we cannot outlaw stupidity, but we can and we must address excessive leverage. Have we done so? No. Now, it's not for lack of trying. The first attempt involved a rewrite of Basel. And as you all know, the new rules toughen up on the definition of risk, and they set an overall cap on leverage. Are the rules tougher than before? Oh, yes. Are they tough? No. Most importantly, are they sufficient to ensuring stability and restoring confidence? No. Let's take an example. Remember CDOs squared, collateralized debt obligations squared? Mini masterpiece of financial engineering that all ended in tears and sowed market panic. Well, the instrument still features on the roster of risk-weighted assets, and the risk-weighted asset regime determines the amount of capital required in support of such risks. So how much loss-absorbing capital do you suppose the new tough rules require of a bank to carry an investment in a debt obligation, backed by a debt obligation, backed by a pool of loans, made to U.S. subprime residential homeowners? Oh, and let's assume that yet again they're rated AAA by one of the finest credit rating agencies in the land. What do you think? After all, loss-absorbing capital requirements should have some relationship to the losses that capital might have to absorb, right? So what do you think? 20% of face value? 10%? 5%? Well, for your information, the tough new rules require less than 1.4% of equity funding, and that's for a security that neither banker, regulator, investor, nor rating agency was able to understand. Now, fortunately, Basel III introduces a backstop. Banks are now subject to a cap on total leverage at which they operate. This is a good idea, but as currently set, the leverage ratio allows banks' balance sheets to balloon to 33 times their loss-absorbing equity. At that degree of gearing, a 3% decline in the value of bank assets wipes out 100% of bank capital. A mere 1% decline leaves the institution leveraged 50 times. A 2% decline, 100 times. Now, how confidence-inspiring is that? Evidently not confidence-inspiring enough. Witness the proposals of a number of jurisdictions to raise the 3% leverage ratio to 4 or even 5. Would these be tougher? Oh, yes. Would they be sufficient? No. Those ratios would translate into bank balance sheets some 20 to 25 times their loss-absorbing equity. Hedge funds, by the way, operate on average at about 3 times. There's more, of course. To such top-ups, regulators have added stress testing and TLAC, total loss absorbing capacity. Now, these steps are potentially positive, but compared to capital, they represent a very problematic patchwork. Why? Well, for stress testing to be effective, regulators have to know which risks to stress and by how much to do so. And however hardworking and intelligent they may be, they're also human. And like the bankers they regulate, they will at some point get it wrong. That's why we have capital. Capital is there not just for the risks that we think we understand, it's there for the risks that we don't. And as for TLAC, it's a potentially sound building block, but one that rests on a shaky foundation. First of all, the target for loss-absorbing capacity of a bank is set in terms of a percentage of risk-weighted assets. And we just saw how poor a reference point that may prove to be. Second, various forms of bank debt are deemed to be loss-absorbing. Here the perception is twofold. One, that the authorities will have the guts to force losses on debt holders. They didn't last time. And two, that at the first hint of trouble, debt and equity holders are going to wait around to find out. Are you going to wait around? Why should anybody? In short, the banking system remains and is set to remain undercapitalized. Basel III is a busted flush. And the many measures to compensate serve only to confirm this fact without adequately compensating for its failure. Now, if capital is vital to the survival of our market system, accountability is critical to its legitimacy. That bankers behave badly in the run-up to the meltdown is, of course, old news. That corporate culture was a culprit is now consensus. And we've just heard from our panelists their thoughts on incentivizing good behavior and ethics. So let me say a word about an equal or greater need for the disincentives to bad behavior. But before considering what should be done, I'd like to just recall with you for a moment what financiers did. The charge sheet of misdeeds, both acknowledged and alleged, is quite lengthy. I have brought along a partial list, starting with some that Sue mentioned. manipulation of LIBOR, manipulation of Euribor, manipulation of FX markets, manipulation of gold fixings, manipulation of electricity markets, manipulation of commodity markets, manipulation of the swaps benchmark index, collusion related to credit default swaps, mis-selling payment protection insurance, mis-selling interest rate swaps, mis-selling credit card theft insurance, mis-selling of mortgage-backed securities, mis-selling of municipal bond investment strategies, mis-selling of structured deposit investments, mis-selling of FX products, abusive small lending practices, predatory mortgage lending, abusive foreclosure practices, aiding and abetting tax evasion, money laundering for drug cartels, violations of rogue regime sanctions, bribing civil servants, stealing confidential regulatory information. You get the idea. That's the partial list. And what has been done? Well, there's been a lot of breastfeeding on the topic. Hearings have been held. Commissions have been commissioned. Investigations have been legion, and they continue to this day. Large fines are frequent. But no bank has lost its banking license. No senior has gone to jail. No management team has been prosecuted. No board or supervising executive has been financially ruined. Many have kept their jobs, their salaries, their pensions, and their perks. And among those dismissed, very few have been banned from the field for the future. As to the fines, they've been paid by the shareholders, not by the perpetrators. No doubt some executives see this as a cost of doing business and politicians a handy source of revenue, but few believe it to be an effective deterrent. So is there any wonder that the public has lost faith in finance? Restoring accountability is vital to restoring a sense of fairness. It's also a key to reducing recklessness, because the first line of defense in financial risk-taking consists of the attitudes and the practices of the risk-takers on the front line. If they don't know the difference between right and wrong, if wrongdoing is left unpunished, much less rewarded, then we deserve what we get. Now, as to progress on this point, I was hopeful, but like Sue, I'm no longer optimistic. I was hopeful because for a while, regulators, politicians, and practitioners were all making the right noises. Parliament took steps to strengthen sanctions for financial wrongdoing. The U.S. Attorney General declared that no bank was too big to jail. FSB Chair Mark Carney called for, quote, clear consequences, including professional ostracism, for failure to live up to the necessary standards. And more recently, Chancellor Osborne declared that, quote, there is no trade-off between high standards of conduct and competitiveness. Banking executives individually and collectively were also talking the talk. But of course, actions speak louder than words, and actions to date fall far short of what was both needed and possible. Making crimes a criminal offense is helpful, but enforcing the laws already on the books can and must happen first. If you add new speed limits when you've not enforced the old ones, that's a pretty shaky basis on which to slow traffic. And the disturbing fact is that laws have been broken, but law breaking has not touched senior management. The U.S. deferred prosecution agreements have been the order of the day, and although such settlements are announced with fines and fanfare, the detailed evidence and findings that led to such agreements remain hidden from the public eye. Similarly, rules and tools that exist already have sat untouched. The UK's Financial Services Authority and its successor have long had the ability to oust bank management and board by striking them off the approved persons list. Have they done so? Not to any significant or visible extent. How can this be? Look again at the litany of wrongdoing. Either senior management knew what was going on or they didn't. If they knew, they were complicit. If they didn't, they were and are incompetent. Alternatively, if the deserving dozens have indeed been banned from the field, please let the list be known, that we can see some of that professional ostracism of which Governor Carney speaks. As Sue mentioned earlier, one person who did lose his position, and quite publicly at that, was Martin Wheatley, the UK's courageous conduct enforcer. Meanwhile, the chairman of Europe's largest bank remains in place, despite having been on the board since 1995, despite having signed off on the acquisitions of household finance, despite having had oversight of tax-entangled subsidiaries in Switzerland and money laundering units in Mexico. Oh, and you'll love this. The recently retired chief executive of Standard Chartered Bank is now reportedly an advisor to Her Majesty's government. Standard Chartered was, of course, among the first to be investigated for violations of rogue regime sanctions. The bank was fined heavily and may soon be again. In his new book, Ben Bernanke speaks about the courage to act. Central bankers did indeed act courageously and decisively to bring the banking system back from the brink. They had the full support of the political elite to do so. We owe them all a debt of gratitude. But in reforming the system that they so successfully saved, the authorities have been unwilling or unable to stand up to the politicians who in turn have been demonstrably unwilling to stand up to the banking lobby. Why? Well, that no doubt is a theme for a subsequent conference. But today's theme is confidence, ethics, and incentives. I respond with capital, accountability, and courage. Unless we address leverage, we cannot have confidence in the resilience of the system. Without better behavior, we cannot have faith in the markets that underpin it. Without penalizing the perpetrators and their seniors, we will not get better behavior. And without greater courage from the policymakers and regulators, we will get none of the above and more of the same. Ladies and gentlemen, when timidity triumphs, the taxpayer pays. And alas, timidity is the order of the day. Thank you.